Welcome to our discussion of Moody and Poor, the rating agencies in the subprime fiasco. I'm Joe White, Luxembourg Family Professor of Public Policy here at Case Western, and it's my great pleasure to welcome you and to welcome our guests, Mark Rome, Associate Professor of Government and Public Policy at Georgetown University, and Kathleen Engel, Leon M. and Gloria Plevin, Associate Professor of Law at the Cleveland Marshall College of the Law. Our topic today is a policy disaster, and I'd like to make a couple of framing comments before turning it over to our speakers, and then I might make a final framing response before opening this up a little more. The basic framing comment is that when I think about public policy, it seems to me that there are three things that are necessary for policies that work. And I guess this is true of private policies as well as public policies. The first thing that's necessary is knowledge or technical capacity. You have to have a clue how to do what it is you're trying to do. There has to be some reasonable theory of relating means to ends. An example of this is curing cancer. Well, the fact is we have failed to cure cancer for the last 37 years since we declared war on it. We occasionally make some progress, but on the whole, we are still trying to develop the technical capacity, the knowledge to accomplish the goal if you think that is the goal. There are other definitions of the goal which we know better how to do. Spending a lot of money on research on cancer, that we know how to do. Curing it, much harder. A second dimension is, in addition to knowledge, is will or political capacity. And that is the ability to agree to pursue a goal. Classic example of a problem which is a will problem is national health insurance. There's no technical capacity problem in doing national health insurance at all. Lots of people have done it. There are many models. It's easy. You take the Social Security Act, Title 19, I believe it is, maybe Title 18 of the Social Security Act. At every point where it says at age 65, you say at birth. And at every point where it says 1.45% of payroll from employer and employee, you say 6 or 7 or something like that. And you've just created national health insurance. Not a technical problem, really, but it's a major political will problem. And the third thing that happens in public policy, both that you have to have in order for policies to work and that you often don't have when policies fail, is institutional capacity. The ability to, through the institutions of either the government or the private sector, whatever kind of policy you're talking about, actually implement the policy you're talking about. Classic example of an institutional capacity failure is prohibition. Managed to pass prohibition. Turned out we were not able to implement prohibition in a way that was acceptable because of the limits on what government can actually do. I suggest that we might want to think about all three dimensions, knowledge, power, and will, in thinking about the problem that Professor Rome and Professor Engel are going to discuss, which is the failure to accurately rate and thereby protect people against failures in the market for mortgage instruments. With that, I'd like to turn this over to Professor Rome. Slides up.
Thank you very much, Joe. I'm coming to you today in my role as Sarah Palin. That is, fresh-faced, spunky, a person of the people, so long as the people are not experts in the credit rating agencies. In fact, 2 months ago when I was first asked to conduct some research on the credit rating agencies, I knew little about them, but I did not even blink when asked and agreed immediately to do so. So I will present some ideas about the credit rating agencies. Now, I will admit I have never actually been in one or worked with one. However, I have been in Manhattan and have seen them. Now, after I give some comments, I will be able to turn the mic over to my dear colleague, Joe Biden, who, as far as I can tell, actually knows what she's talking about on these issues. And her task will be to show why I'm wrong or misled in ways that are complimentary and not humiliating. And then the mic goes back to my long-term friend, Joe, better known as Joe Obama White, who will give an inspirational talk as to why I'm a fool. Okay, next slide, please. Credit rating agencies. I hope you don't mind. I'm a little bit, I do like that Oprah feel of walking around the audience a little bit. The credit rating agencies, well, when I started thinking about them, they struck me as represented by three terms: mystical, omniscient, powerful. Mystical. The rating agencies are somewhat of a mystically anointed monopoly, not unlike our good friends Fannie and Freddie, with even less accountability. They're omniscient. How are we doing the next slides here? Who's fine? Next slide. They're omniscient. Everybody in the markets assumed that the credit rating agencies knew what they were doing. Next slide. The credit rating agencies, the CRA, were powerful. In the words of Friedman, you could almost say that we live again in a two-superpower world. There's the U.S. and there is Moody's. The U.S. can destroy a country by leveling it with bombs. Moody's can destroy a country or a firm or a sector or a bank by downgrading its bonds. Mystical, omniscient, powerful, and important. Next slide. During this past decade, we've seen the rocket go up, we've seen the rocket stall out, and we've seen the rocket fall back to earth. Between roughly 2001 and 2006, the U.S. mortgage markets made explosive growth, both in the prime and in the subprime markets. Lots of money was made buying and selling houses. The credit rating agencies engaged in assessing the quality of the debt securities based on these mortgage markets, and everybody was getting rich, including the credit rating agencies. About 2007 or so, maybe slightly earlier, that rocket stalled out, and what went up came down fast. If you looked at the New York Times today, or the Wall Street Journal, or the Washington Post, and you forgot to sell your stock in Lehman's, you're broke now. Those who invested in these mortgage-backed securities and their various derivatives associated with them and bet the bank on them lost that bank. I don't know the full extent of the damage. My understanding is something like $250 billion or north of that in housing values associated with the housing market will vanish, have vanished, or will vanish. And I tried to adjust the slide to make the arrow go down to here or so, because we don't know where the bottom is. We're not there yet. Okay, next slide. So when I was contacted by the editor of the special issue for the Public Administration Review, I am a political scientist. She posed two questions that she wanted me to address as a non-expert in credit rating agencies, as a non-financial person, not an economist, but someone who is interested in politics and policy. And here are the questions that she asked me to consider. What was the role of these credit rating agencies in the mess? Did they cause it? Did they try to stop it? Were they complicit? What did they do? And if I find some problems, and we did anticipate that I would find some problems, what do we do to stop those problems from coming back? Okay, next slide, please. So here's what I'm going to do today. I'm going to talk a little bit about the basics of the credit rating agencies, and I do that because as a novice, I want to make sure that my understanding of what they do and how they do it accords with your understanding, and I will look forward to your suggestions about where I get this right and wrong. Then I want to talk about the mess. By the way, I realize I am fairly caffeinated, so if there are times when I go too quickly, you can just say, Mark, what you said was so eloquent. Would you please say it again? Okay, so I'll talk about the mess. Talk about the mess a little bit. I'm going to talk about what I think are the major causes of the mistakes the credit rating agencies made. Credit rating agencies may disagree. You may also. And then finally talk about some reforms. Okay, next slide, please. Okay, what do the credit rating agencies do? Okay, let me just sort of give my briefest understanding of that is, markets comprise buyers and sellers. Okay, usually they deal directly with each other. Seller wants to sell something, buyer wants to buy it. They negotiate, they strike a deal, it's done. Okay, that works best if the buyers are equipped to assess the quality of the good that's being sold to them. They can make the judgments on it. Okay, but as the world becomes more complex and the buyers are less able to actually assess what they're buying, it's helpful to them and it's helpful to the sellers to have some intermediary, some group standing between them that is neutral and that's credible, that can say, here is the quality of the thing that's being sold to enhance the confidence of the sellers and the confidence of the buyers. Now, think of this in particular regarding non-material items, not apples, but debt. The sellers are trying to sell promises that they will repay the buyers. Give us your money now, and we promise to repay you. Well, if you're a seller, how can you trust that promise? You can trust it if there's a credible, neutral party that can evaluate the chance that that seller is going to repay you. Okay? That's what the credit rating agencies do. They have one primary task. That is, look at what's being sold and say, what is the likelihood that the principal and the interest for this debt will be repaid in a timely fashion. Period. That's what they do. They don't say buy it. They don't say sell it. We say we've evaluated it. Here's what we think about the probability that it will be repaid. Okay? And markets evolved to do that, particularly Standard & Poor's, S&P, Moody's, and Fitch. They've been around a long time. These three credit rating agencies, and I'll come back to that word in a second, now they rate the vast majority of global ratings. Okay, the vast majority. S&P and Moody's alone do about 80%, I think, of global ratings, and we're talking about lots of ratings. 2002, Moody's, I think, had about 150,000 ratings, recent ratings. So they rate a lot of stuff, okay? And they evolved to provide this kind of service, okay? That's the pure market aspect of why we have these credit rating agencies. But now there's an important regulatory aspect of them in the United States as well. That is, various regulatory bodies, the Securities and Exchange Commission, among others, have rules about how the sellers need to treat their assets and how the buyers need to treat their assets. Okay? So, for example, pension funds are not typically allowed to buy securities, the debt, unless it's considered investment grade. Okay? Well, who decides what is considered investment grade? The credit rating agencies. Okay? So they fulfill a regulatory purpose of the government to deciding what is investment grade and what is not investment grade. And that has lots of regulatory implications for these other financial institutions. Okay? That's why we call them credit rating agencies and not just firms. They're privately owned. Their source of revenue is primarily through the market, but they serve this public purpose for these other sets of institutions. Okay, what's not on this chart? Okay, you have the buyers, you have the sellers, you have the raters. Where's the government? These fulfill a public purpose. Where is the government? It's not on that slide, and for good reason. Through the 1990s into the 2000s, the credit rating agencies were loosely regulated, if at all. The SEC designated a certain small set of them as nationally recognized statistical rating agencies for regulatory purposes, had very modest oversight over them, but these basically were on their own. They were rating without control by the government. Okay? So, lacking regulatory authority over them, why were they valuable? One word, their credibility. As long as they were seen as credible, they could provide a public service. Credibility was their coin of the realm. Okay, next slide, please. Okay, so how do these credit rating agencies do it? Okay, what's sort of the process that we're going to step through? Okay, simple schema here. I'll just do it very quickly. Some company that wants to issue a bond or some other kind of debt security, and we have lots of very elaborate ones. We'll talk about in a little bit. They can request that they get a rating so they can sell it through the markets. They select some credit rating agency. They have choices, typically Moody, Fitch, and Standard & Poor, but they get to choose among them for which ones they want. Once they've selected a rating agency, that rating agency will develop a team that will do the assessment of the debt that's going to be issued. Okay, so they get their analysts together. They figure out what kind of models they're going to use. They get to conduct basic research about the quality of the debts being issued, and so forth. Rating committee meeting with those who are issuing the debt, where they say, we've scrutinized the debt that you want to issue. Here is the rating that we propose to give it. There will be some discussion between the issuer and the credit rating agency. The issuer, that is people who want to sell the debt, they can appeal the ratings and so forth. But at this rating committee meeting, then the committee will decide we are going to rate this debt based typically on some sort of alphabetical scale. So AAA will be your highest rated security. That is the security that we are most confident will be paid back principal and interest in a timely way. Down to some other category, C's or D's or R's, that's basically say it's not going to be paid back, or it's very unlikely to be paid back. Okay, so we're giving a rating on what we think about the security. Okay, and these ratings fall into all sorts of different tiers, from the highest, the most safe, to the most insecure. Okay, now that rating is going to affect how much that security will be worth. If you have a AAA, if you've got the highest rated security, then you can offer a low rate of interest on that. That is, it's cheaper for the issuer to repay a high security. A risky security, a lower rated one, the issuer is going to have to pay a higher rate of return to the buyer because the buyer is taking more risk. Okay, so the rating identifies the risk, which also then identifies how much the security, how much interest rate it will draw. Okay, so the issuer rating, we call this security a triple B or BB plus or whatever. Okay? Then you conduct surveillance, because once that debt is issued, then it may become riskier or it may become less risky. Okay, so there's this process that we go through that determines what rating will be offered for the issue. Okay, all right, next slide, please. Oh, and we will come back to some of these points. Okay, now, so we've seen the basic sort of where the ratings fit in, how the ratings are done. Let's look at the mortgage markets more closely. Okay, here is the process that we've seen for the mortgage markets in the United States in the 21st century. Okay, typically starts off when a home buyer, someone wants to buy a house, obtains a mortgage. Okay, a bank or some other lending institution offers the mortgage to the home buyer. Okay, closes the deal, then typically does not keep it on its own books, but sells it to someone else. So they'll sell the mortgage to something like an investment bank. Investment bank including things like Freddie and Fannie, okay, or a private investment bank. Okay, these investment banks then aggregate all these mortgage loans and they bundle them into various kinds of securities. So you may take thousands of mortgage loans, put them together in a big package, and then figure out how to sell them as securities. Okay, now, what do these securities look like? And again, financial experts beware, a novice speaking. Okay? We bundle them up, and then we cut them into slices called tranches. Okay? These slices have different levels of risk and return. So you pull these mortgages together, and when you slice them, the senior tranche, the most highly rated tranche, is considered to be highly safe. Okay? Then as the tranches, these slices, become more junior, they become increasingly risky, have increasingly high rates of return. Okay? More risk, more return. Okay? Then these slices are sold to investors who can buy them based on their preferences for risk and return. Okay? Now, it matters a lot how these things are sliced up. Okay? Because the people who are selling these, the people who are, the investment banks that are selling these, they would like to have everything in the sort of the highest tranches, right? See these things as being safe, so they have lower rates that they have to pay on financing them. Okay? Okay. Now, I don't really know how this bundling and slicing takes place. This, to me, looks like this is the sausage factory. Okay? I don't see it. I see the meat going in. I see the sausage coming out. All right? Okay. So they're sliced into these different tranches. The credit rating agencies rate these tranches, say how secure they are. Okay? Once they do so, once the ratings are issued, these things are sold on the market. Investors can buy them. Okay, cool. Next slide. Oh, I'm sorry. Can we go back to the previous slide here? Yeah. The two things I want to mention. These debt securities that are being sold, the two most important ones for our concern are mortgage-backed securities or residential mortgage-backed securities, RMBS, and these crazy beasts called collateralized debt obligations, CDOs. Two forms of securities that were largely linked to the mortgage markets. The mortgage-backed securities actually have the mortgages as collateral. Okay, they're debts issued based on this collateral. The CDOs, the collateral is sort of other securities. Okay, so CDOs are even more complex, more elaborate sort of slicing and dicing. Okay, next slide, please. All right. So, the mess. Okay. I'm going to do a quick timeline, and then I'm going to give you my assessment about why the mess occurred. Okay? So we're going to first understand the mess, and then I'll talk more about why I think it happened. Okay? Let's begin it at 2001. Okay? I choose 2001 because that is the beginning of the growth in the mortgage markets, the explosion in the mortgage markets. Also, anybody remember the name Enron? Okay? Enron exploded in 2001. Okay? One of the curious things about the Enron collapse is that up to 4 days before Enron declared bankruptcy, the credit rating agencies considered Enron debt securities as investment grade, safe and secure for investors, up until 4 days before its collapse. Okay? Well, when Enron collapsed, Congress thinks that we've got some problems that we need to take care of in the way that we do accounting practices and the way that publicly traded firms disclose their debt and so forth. Okay? So Congress passed the Sarbanes-Oxley Act mainly to work on sort of auditing reform and disclosure reform for corporations. Okay? Part of this Sarbanes-Oxley Act, though, did say, gee, SEC, Securities and Exchange Commission, what about those credit rating agencies? Why did they call Enron safe and secure up until the very time it collapsed? We want you to conduct some investigation work on them. Okay? So Sarbanes-Oxley sort of implicated this. All right, so that's past 2002. The mortgage boom really takes off in 2003. And we're talking about rapid growth. The revenues of the credit rating agencies basically approximately triple in a several-year period, as do their stock prices. I think Moody's stock maybe quintupled, centupled, pentupled. The credit rating agencies are making a lot of money, and their stock's going up a lot because they're doing a lot of work rating these securities based on the mortgage markets. Okay. So the boom's taken off here. SEC conducts a study of the credit rating agencies and says, here's what we found from the Enron problem. Let me go ahead and read that to you if I can, although I'm going to get my glasses on here. Hold on just a second. Are my glasses somewhere? I'm going to have someone read for me.
I'm not sure people can deal with the different accents.
What do I do with my glasses? Okay. Here's what the SEC found regarding the Enron case, and go ahead and listen carefully. The credit rating agencies failed to use their legally sanctioned power and access to the public's benefit, instead displaying a lack of diligence in their coverage and assessment of Enron. The credit rating agencies did not ask sufficiently probing questions in formulating their ratings and, in many cases, merely accepted at face value what they were told by Enron officials. Further, the rating agencies apparently ignored or glossed over warning signs and factors affecting the long-term health of Enron, et cetera, because credit rating agencies are subject to little, if any, regulatory oversight. Little exists to hold them accountable for future poor performance. Okay? That's a staff report of the SEC. That's written in 2003. They called it almost precisely about what was going to happen. Because as the credit markets are booming, the mortgage markets are booming, the credit rating agencies displayed sort of an astonishing lack of diligence, of assessment, of good judgment, of procedures in evaluating the credit risk of the mortgage markets. Okay, so SEC called in 2003, but the SEC did nothing about it then. At the SEC's report in 2003, the argument is the SEC lacks explicit regulatory authority by Congress to conduct aggressive oversight. We can make recommendations, we can issue reports, not really our job until Congress gives it to us. Well, Congress did act in 2006 through the Credit Rating Agency Reform Act, which finally gave the SEC explicit regulatory oversight authority over the CRA. Oversight authority. So we want you to check out on them. We want you to define what we consider to be these NSROs, the nationally statistically recognized rating organizations. Okay, so we want you to define them. We want you to oversee them. But Congress said you may not involve yourselves in changing or regulating the methods that the CRA use to rate debt securities. Oversight, but stay out of the methods. Okay, that's their business. Okay. Then everything goes south. Everything goes south. And if the SEC were to issue a report today, they would repeat probably verbatim the assessment of the credit rating agencies from Enron. But note, though, Enron was a singular case of deception. The mortgage markets were sector-wide failures for the credit rating agencies. Next slide, please. Okay. Let me go colloquial on y'all for a second. Okay? I'm going to move away from any sort of technical speak of NSROs and CDOs and all that kind of stuff. Here's what happened in my outsider view of the mess. Okay? Those taking out home loans, the borrowers, liars, fools, and luckless. Okay? As the boom turned on, underwriting standards for home mortgages slipped dramatically, so that no-doc loans you don't have to provide any documentation. These are also called liar's loans, came to comprise something like 40% of the subprime market by 2006. Okay? Quick story. I bought a vacation home a couple years ago. I live in an apartment, so this home was going to be my primary home. Okay? The loan was approved in about an hour without documentation, and I'm the only name on the mortgage. My girlfriend it's half hers, so she's paying half the mortgage. But at the time, I looked at the bank official and I said, how can you possibly be throwing this much money at me? I clearly am not able to repay this mortgage. You qualify for it. You're fine. Okay? So, and I actually told the truth about how much income I make, too. I'm a political scientist, too, not one of those business school professors. All right? So, okay, so you had borrowers either lying to get their loans, or people who were duped by the lenders, and you also had the luckless, people who just simply overextended. Okay? So you have the subprime market grew a lot because people were getting loans that they did not have reasonable prospects of repaying. But interest rates are dropping, and house prices are going up. So you think you'll be bailed out. Okay? The lenders, rapacious and duplicitous. Again, I know I'm simplifying, but the banks and other lenders were eager to get those mortgage loans signed. They did not do due diligence. They often offered loans with teaser rates. Pay 3.5% on this loan for the first 4 months. And then your loan will go up, will adjust towards the prime rate, which is going to start rising again in 2006. Okay? Banks made loans to people they should have made loans to. Okay? And often I think those loans were ill understood by those people who bought them. Okay? But that's not the bank's problem. Because once the bank signs the loan, collects its fees, it's going to sell it to an investment bank. Those investment banks, they're alchemists. They are taking a form of garbage and trying to convert it into higher quality garbage. Okay, that is, by the slicing and dicing, by combining, you're hoping to produce high-rated securities about this. This is increasingly difficult because the underlying assets are dubious. Okay? But the investment banks figured, we can keep doing this. We can figure out ways to sell things that will be highly rated, that will find a place in the market. Okay, so they're slicing, dicing, CDOs, MBS, etc. Credit rating agencies, in my view, they're enablers. Okay? They are giving high ratings to securities that they should have been much more skeptical about. And I'll tell you why I think so in a minute, too. And the investors ultimately were chumps. Okay? Investors, you think, well, I've got these safe securities, they're high yielding, I'll take them without doing due diligence. Why not? Because these securities, the MBS and the CDOs, are really, really complex. We don't understand them. But what do we do know? The credit rating agencies essentially put a good housekeeping seal of approval on them, saying these are investment grade. And lacking the ability to understand what's in these securities, the good housekeeping seal of approval was adequate. Next slide, please. Okay. I had to wear a suit to be so hostile to the business folks here, right? I couldn't do this in casual clothes where I look like some sort of anarchist. Okay, so mistakes. Where'd the CRA go bad? Okay, I think there are three major things that were worth considering about their problems. Okay, incentives, or greed, ignorance, and stress. Okay, incentives, ignorance, or stress. Let's consider the first one for a second. And here's the primary incentive problem I'm concerned with that. When the CRA issue ratings, they are paid by the issuer. That is, those people who have a lot of incentive to have their products rated highly, they're paying the raters. Okay? This creates a basic conflict of interest. Okay? The rating agencies want to be credible, but they're rating for the people who want favorable ratings. Now, these conflicts of interest are ubiquitous in the business community. Realtors, work for the sellers, not for the buyers. Newspapers have to cover the people that they receive advertising money from. College professors grade those people who are paying their salaries. Okay, so we have a lot of these kinds of conflict of interest. So that's not unique to the CRA, but I think it's important for the CRA. Next slide, please. Okay, and here's the here where we can think about the conflicts of interest come in. By the way, the CRA denied that conflict of interest problems were very important. They said credibility is the coin of the realm, so we have to be credible. Well, selecting which agency you want, boy, people have incentives to forum shop to find a rating agency that will give them a favorable rating. Okay? Thinking about how the research team will propose. Well, the people on these teams know where their bread is buttered, presumably. They know that the people who want ratings want favorable ratings. Well, can we tweak the issue a little bit? Can we tweak our model a little bit? I'm not saying that they did. I'm saying they have incentives to do these things at the analytical level, as well as at the rating committee level. Okay? Now, finally, an issue of the rating, they have incentives to give higher ratings rather than lower ratings. And then in surveillance, knocking an issue down is difficult. I think they have some incentives to keep ratings high. Okay? So there are lots of incentives in this system for the CRA to have gotten slack, to have grade inflation. Okay? Now, the CRA denied that this happened. Okay? Well, here's my assessment on some of the evidence on that. That is, if I can find my evidence of that. Okay. Oh, okay, so the CRA say we have to maintain our credibility. We have firewalls. We have adequate firewalls. And, after all, no issuer is large enough to really be worth ruining our reputation for. Okay? Let me cover those in some reverse order. Those things may have been true for most of the raters' histories. I think it was not. It was less true in the 2000s. Here's why. There are lots of companies issuing ratings that are only of small value. Concerning the mortgage markets, about a dozen issuers counted for something like 80% of the mortgage-backed securities and CDOs that were issued. A lot of concentration among issuers. The rating agencies then, they want these people's business. And I think their standards perhaps lower during this period. Firewalls were breached. I think there's fairly clear evidence from the SEC reports that people in the rating agencies knew how much these ratings were worth and may have adjusted, sometimes out of the model, their ratings accordingly. And finally, here's I think the key point. Rating agencies want to maintain their credibility. If maintaining their credibility was their main goal, they did fail at it. They have lost their credibility. Why? Well, here's some reasons of evidence. They conducted scant surveillance on the quality of the things that they rated. Why not? They're not paid to do so. They're paid at the time that they issue the rating, not for surveillance. Okay? If they cared about their credibility, they must continue surveillance. They didn't. They downgraded few mortgage-backed securities until things got bad, then they downgraded thousands at once. I think that shows inadequate surveillance. Do they value their credibility? If so, they should document how they do their models, how they conduct surveillance, and when their models change. Did they always do so? No. We don't always know why the ratings were changed and how the models were applied. And finally, if credibility is the coin of the realm, they just misjudge the risks. They misjudge the risks. Now, why did they misjudge the risks so badly? Next slide, please. Here's what I think. Okay. Could be ignorance. They misjudged risks because of ignorance. Okay, next slide. Now there's a couple different kinds of ignorance that I want to talk about. There's naive ignorance. That is, we didn't know and we couldn't know. And then there's willful ignorance. That is, we didn't know, but we could have and we should have. Joe, how are we doing on time here? Getting close? Yeah, okay, good. Okay, so here's what I want to say about ignorance. They were. They shouldn't have been. How were they ignorant? If you're rating conventional home mortgage loans among conventional buyers, they knew what they were doing. They had a lot of experience doing this. In the 2000s, the type of borrowers buy, they become much more subprime. The type of loans change. They're not standard fixed-rate loans. They're more variable rate. There are different kinds of periods. They have different kind of interest rate triggers and so forth. So what they were rating changed a lot. The underlying assets they were rating changed a lot. Okay? They didn't understand how these were going to react. The underlying assets are changing, and the securities based on them are changing also. CDOs and MBSs that were, I think, probably, apparently, ill understood by the agencies. So they didn't know. They didn't predict mass correlations in defaults. Kind of odd for groups that make risk assessment their business. And one other kind of ignorance they revealed, they demonstrated. These people found it hard actually to, even if they'd wanted to conduct their own due diligence, it would have been hard for them to do so because the ratings models were so incomplete. It's hard for these people to figure out what happened in the ratings models. Okay. One final illustration of ignorance. The rating agencies took the issuer's words for it on what was in those assets. Okay. They did not independently audit or monitor the quality of those assets themselves. Now, just one sentence on this. If a public health inspector came and said, I went to the restaurant and I asked the owners if there were any health problems, the owners told me no, therefore the restaurant's fine, no one would find that credible here. But that's what the credit rating agencies did. We were told information, we rated it, that's what we got. Okay, finally, next slide. Another cause of the mistakes, stress. Stress. Big arrow, a lot of growth, pressure for credibility. Which pressures were more important? Next slide. Here's how I see it. Just a couple of graphs. I'll see how you see it. Okay. This graph shows three things. The growth of residential mortgage-backed securities in terms of revenue, in terms of the number of deals rated, in terms of the staff rating these deals. Okay. For at least 2003 through 2005, revenue grew much more rapidly than ratings, which grew more rapidly than staff. That is, staff, which tend to be new because they're growing fast, are growing much less than the deals. Okay, you have newer staff doing more ratings. Next slide. Especially for the CDOs, revenue, ratings, staff. 500% growth, 400% growth. CDO ratings and revenue exploded in the 2000s. Staff did not. Okay, so staff with incentives to give good ratings. Okay, with a fair amount of ignorance and with a lot of pressure, gave too many favorable ratings. Okay, next slide. Yeah. All right, so what are we going to do about it? Remedies. Okay. Just a couple of things to think about. These are less well developed in my head, so let me suggest them. Three possible remedies because of three possible problems. I'll go in reverse order. Stress. Okay. CRA were under a lot of stress because they grew too fast. There are ways to remedy this. The SEC says they should monitor their staffs. Okay. They should make sure they should disclose that they have sufficient staffs. Okay, that's all well and good. This kind of reform is probably moot though because the markets, they're not issuing a lot of ratings these days. Okay. Okay. Ignorance. Okay, what do we do about the ignorance problem? Okay, most of the focus has been on more disclosure, better auditing, and so forth. I think these are SEC regulations or proposed regulations. Those make some sense. Those have merit. But in my view, because the main thing that the rating agencies do is to provide information on the risk of debt securities, whether they'll be repaid or not, if the CRA do not have adequate historical information to rate the risk, they shouldn't do so. If you don't have good data, you don't rate. People can buy and sell debt securities, but just not with a good housekeeping seal of approval on that. Finally, the incentives. There are a lot of concerns about what to do with this basic issuer pays problem, the conflict of interest inherent in that. One possibility is get rid of the issuer pays, have the government do the ratings. Fair amount of skepticism on that we can explore in the discussion. Another possibility that's been suggested is just open up the market. We only have 3 major CRAs. Let's have a bunch of them. Let them compete. See who's most credible. Bad idea. So long as you have issuer pays incentives, having more people compete for the issuers is likely, in my view, to lead to worse ratings rather than better ratings. Another possibility is to get rid of the issuer pays and move to a buyer's pay model. Y'all are probably more expert in how to do that than me. I'm not sure that that can be done. So this is going to be a problem. That what we're doing now, and we'll probably continue to do, is not get rid of the fundamental conflict of interest, but try to find ways to develop higher, more fireproof, more sound firewalls to prevent the subprime mess of the first decade of the century happen again in the next decade. Okay, thanks very much. Kathleen, I guess it's, or I yield the mic to Senator Biden at this point.
While this is getting set up, I'll start. I'm actually not going to use the microphone because I fidget way too much. So I'm going to turn that off. I have no choice. Okay, is it on? All right. I'll see what I can do here. I should start by saying that my style is probably more like Jim Carrey's than John Kerry's than Biden's. So bear with me. I'm not so theatrical. And I also want to say that the real expert here on these kinds of deals is Peter Rishkin. So any questions or responses that I have are subject to his critique as well. So I just wanted to say a couple of things about the talk itself, because I had read the paper ahead of time, but certainly the talk included some things that the paper hadn't developed so well. And one of the points is really, what is it that the rating agencies did wrong? And I think it's important to chronicle what some of those things are. One is that they didn't check to make sure that the loans included in these securitization deals weren't included in other securitization deals, which has turned out to be what's happened. That any single loan could be in several different deals, and the same is true of the RMBS, the residential mortgage-backed securities, ended up in more than one CDO pool. So that's one thing they could have done. Another thing is that in the agreements that are put together in these deals, there are exception provisions. So there will be representations and warranties where the originators or the purchasers from the originators will say, these loans all have these certain qualities to them, sort of minimum standards. And then they will say, but there are some exceptions. And in some of the pools, the exceptions were more numerous than the loans that qualified. So that should have been a red flag to the credit rating agencies. The other thing is they didn't take into account the multiple levels, the leveraging that was happening, because these mortgage-backed securities were put into the tranches and then they were resecuritized, and that leveraging of one single loan in all these other instruments meant that the risk was much greater than it appeared if you just looked at a single issue of the securities. And let's see. Oh, and the other thing is they didn't do adequate document review. I was just at the American Bar Association meetings, and I was on a panel with a guy who's a big shot for Jones Day's securities litigation division, and he was doing contract review. And he told me that when he looked at some of the deals, they would have provisions, like waterfall provisions are what specify which tranche gets paid when and how much and how quickly they get paid off. And in these contracts, these billion-dollar deals, there would be a bracket saying, insert waterfall provision here. And all of these documents would have been signed. They would have gone through the rating agencies, through due diligence review, and they didn't even have the basics provision about who gets paid how much when. So the rating agencies, part of their process of giving the ratings is that they should have assured that in the documents it said that actually the investors would get paid ultimately and how they'd get paid. Okay, so can you go ahead and advance the slide? So now I'll talk not so much about the talk, but just more generally about the paper and the current situation. One of the things that this whole subprime crisis has revealed is that there are problems at every level of the market, where you're talking about, it goes all the way from the borrower to the broker to the lender to the rating agencies, the due diligence firms, the investment banks, the broker-dealers, the issuers. And right now there's been a huge amount of focus on firm failures like Lehman Brothers and Bear Stearns, and foreclosures. What do we do? Do we have mass modifications? If we are going to put into place foreclosure moratoria, what would they look like, and things like that. But we can't lose sight of the fact that there were key regulatory problems that we're going to need to address too. And right now we're just in this emergency mode. So one of the real values of this paper is that it addresses some of the fundamental problems in the market that aren't going to go away even when the current crisis abates. So I think it contributes to the sort of long view of where is regulation needed and what should it look like. Next slide. So Mark's paper really identifies 4 problems, 3 of which he discussed. I think the 4th one you didn't talk about so much, which was the slowness of the government agencies, but primarily looks at incentives, ignorance, stress, and slow response time. I want to just talk a little bit about the first 2 of those because I have a little bit of a different take on them. So go ahead. Okay, keep going. I just learned how to do that appear function. I was visiting my daughter at college before I gave a talk at Cornell the other day, and she taught me how to do this. Okay, so since the way that rating agencies come into existence is they have to get approved by the SEC. And it is a cumbersome process, and there have been a lot of limitations on new entrants. So since 1975, we've only had 4 new credit rating agencies on top of Moody's, S&P, and Fitch. And all 4 of those through mergers and acquisitions are now gone. So we're still left with 3 credit rating agencies. Next. One of the things, and this is just a small quibble I have with you, you talked about how the issuers go to one rating agency, they pick who they want. Well, actually, they usually go to all 3 because it's considered due diligence to do that. So it is that an oligopoly or just a monopoly? I don't know which it is, but which is it, JB? It's an oligopoly, right. Okay, so they have to, so since they're going to all 3, you've really reduced incentives. So I don't think, to perform well and things like that. So I don't think they're that worried about credibility. And even if we do, and now the SEC has passed new regs that will encourage new entrants into the credit rating agency business, there's going to be a problem with issuers going to these new entrants because they don't have a track record. So say you're an issuer, you're going to go to, Tom Fitzpatrick Rating Agency, former student of mine here, and then when they're engaging in due diligence or there's some type of lawsuit by investors, they say, why did you go to this guy when you had Standard & Poor's? So there are going to be market incentives to stick with the tried and true, even though there are problems with them as well. The other thing, the other important issue is part of the reason the rating agencies have had so much power in these deals is because there isn't price transparency. Most of the issuances of these securities are private placements. There isn't an open public market. So we know with equities, or we don't know, but we believe that with equities that information moves very quickly and that if we look at the price of a share of stock, it tells us something about the assets that are backing that stock and that the price is transparent. But because these products are not publicly traded, we can't look at the price to give us a sense of the value or the risk, right? Or I guess together, value and risk. So what investors did instead is they just relied on the rating agency's ratings. They would say, if it has a good rating and the price is right, I'm going to buy it. And what that did, it created excessive dependence on the rating agencies, right? Because that was the source of information. Now, I I don't think all the investors were chumps. I think a lot of investors were incredibly greedy, and they were putting so much pressure on the market to get these issues out that a lot of them were just to-be-announced offerings. So people were signing off to buy these securities, and they had no idea what was going to be in the pool. They didn't know. They couldn't look at the individual loans. It would be to be announced. These are the qualities of the loans that will be at the pool, but they couldn't engage in their own review of the loans. Okay, ignorance. I think saying ignorance gives way too much credit to the credit rating agencies. By the way, I wouldn't use the term CRAs because CRA refers to usually the Community Reinvestment Act, and I think I would just call them the rating agencies. I think people get confused by that. So why don't I think it's ignorance? Well, I started working on these issues in 1999. And at that point, Cleveland was already experiencing elevated foreclosure rates. And we all knew about it. It wasn't a surprise. It was in the paper. There were news articles. Cleveland passed a city ordinance because of it. It wasn't a secret piece of information. And you didn't see any of the rating agencies saying, well, we're going to scrutinize loan pools to see if any of these loans are coming out of Slavic Village in Cleveland where there are these high default and foreclosure rates. They weren't doing anything like that. We know that many major players in financial services made huge bets dating back to 2004 that the subprime market was going to crash, including Goldman Sachs. And so that means that there was some information out there that something was very wrong in this market. And still, the credit rating agencies were giving the good scores. And the housing bubble was obvious. Robert Schiller was writing about the housing bubble 3 or 4 years ago, right? So that should have been taken into account by the credit rating agencies. And by 2006, the agencies did have historical data. The first subprime securitizations, I think, were done by the Resolution Trust Corporation in the 1980s. And certainly Fannie and Freddie were in the game by the 90s, and the subprime market developed in the 90s, so they did have historical data on the performance of subprime loans. What they didn't have historical data on were the funky products that emerged in 2006, the 228s and the 327s. And I actually have some thoughts about those two I could talk to you about privately. Those are products that had the teaser rates where you would pay a very low interest rate for the initial term of the mortgage, and then it would jump up to a much higher rate. And part of the reason there was such a boom during that period of time was because as the housing bubble kept growing, people couldn't qualify for traditional fixed rate loans. So and they would get qualified on the teaser rate, not on the fully indexed rate of the mortgage. And so it was a way to get more borrowers to qualify. And there was the financial services firms, the investment banks, and the rating agencies were kind of putting pressure on the lenders to offer these types of loans because they were making their money on volume, and interest rates were actually going up, not down then. So, and people who wanted to refinance had already refinanced, so the market was drying up for these residential mortgage-backed securitizations. So, with interest rates going up, housing prices going up, people like us who wanted to refinance had already done it. They needed to find a way to generate more volume, and that's how they did it. Okay. So solutions. All right. My recommendation is have the rating agencies be part of the insurance function. I think it solves most of the problems. When the issuers go to the credit rating agencies, the question that they ask them is, what will it take for the top tranches to get a AAA investment grade rating? What do we need to have? And then the rating agencies tell them you need these certain credit enhancements. And credit enhancements take a lot of different forms. They can be subordinated debt structures, they're over-collateralization accounts, all these different finance terms. And one of them is that they get insurance. And what the insurance kicks in when the pool underperforms at a certain level. So it has to reach a certain default rate or reduction in returns. And then the insurance kicks in. This is why AIG is in trouble, is my understanding, is because they were insuring these pools. Well, why not have the insurance company take on the job of figuring out what the risk is of the pool? They have skin in the game, right? And this is something that they're well equipped to do, right? That's what insurance companies do. So that would be my recommendation. And then, okay, so that's it for that. And then I have, next slide, I just have a few questions that I can wrap up here. I have other points that are on here, but it was because I didn't have pen and paper with me while I was stranded at the airport, so I just put them down. We can go through them privately. But some of the questions I think that you might want to try to answer is, do you think the new regulations are going to solve the problems you've identified? Because I think that it's really tricky. The regulations are, these are proprietary models, and they're sort of in a funny way saying, well, you have to tell us the models are good, but we understand you don't have to tell us what the models say, and it's kind of, there's a tension there, and I don't think it got resolved with those regs. And then the second thing is about this sort of governmental private standard setting that's going on here. It's kind of like, it makes me think about this guy Chris Sager's work, who's a colleague of mine at Cleveland Marshall, who does work on Underwriters Laboratories, where Underwriters Laboratories is a private entity, but the government will require an Underwriters Laboratories seal of approval on devices that go into public buildings and things like that. Well, we have the same problem here, which is that under the Basel II Accords, the Basel II is a set of international financial recommendations to prevent financial crises, banking crises. And part of the Basel II Accords say that set out standards for evaluating the credit reserves that banks have. Banks have to keep a certain amount of money on the books. And they refer to the credit rating agencies as a way to measure the value of the reserves. So, and similarly, the SEC does that because broker-dealers, people who are selling this stuff, these securities, the broker-dealers also have capital reserve requirements. And when SEC implemented its regulations, it said that assessment of their capital reserve requirements should also could be based on the credit rating agency. So we have the government saying, in determining quality, we are deferring to a private organization, right? And these are not publicly traded companies. I think all of them are privately owned. So there isn't a lot of scrutiny at all. And that there's quite a fundamental question here about whether we want this kind of private standard setting to be embedded in federal regulation. Thank you.
Thank you very much, Professor Engel. Thank you, Professor Rome. I think I should just see if some of the other people here want to make comments. And if they're willing, I'd like them to come to the microphone. I'd certainly like to hear from Professor Richkin and maybe from some of the others. My immediate comment is that there's a lot of reason to think that this is not something that's going to work very well with private institutions. But I also think that as I've heard the situation described, I'm not sure the government would do a very good job of it either. And the reason is that there's some serious technical capacity difficulties here. And my gut reaction is to say that a lot of this stuff just wasn't rateable. They certainly did a bad job of it. But one thing that occurs to me is that in a lot of situations, you have an institution that's issuing debt. And I can see how you can, like Case Western Reserve University, and we care a lot about our bond rating, but what's really being rated is not the instrument itself so much as the institution that is issuing the instrument. And when you ask who is supposed to evaluate the value of the instrument, after it's already been sold, well, in the case of a bond that's been issued by Case Western Reserve University, that's getting evaluated in a sense because Case Western is going to keep issuing bonds, and so the institutional reliability is being assessed. But it doesn't seem to me that in the case of these instruments, obviously the original seller doesn't care because it's already sold. Case Western cares about its rating, okay, but the original seller of this particular instrument doesn't care. Buyers, you can't charge the buyers because who's the buyer? You don't know who the buyer is yet. And the current owner doesn't want to know either. Because, or put it this way, the current owner may want to know, but it doesn't want anybody else to know. Because the current owner, if in fact it has lost value, will not want will not want that to be publicly known because then it can't sell, right? It'll have to take a loss in selling. Whereas again, if we're rating bonds from Case Western Reserve University, then at least Case Western Reserve University, because it is going to want to sell other bonds based on its good name, will care, and there's a reason for Moody's and so on to do their job. So it's not clear to me when you're talking about sort of instruments that are floating out there, how on earth this is supposed to work. You know, how you have continual evaluation. But I could be totally misunderstanding the problem here. And again, whether Professor Richkin or anybody else wants to make some comments, I'd love to hear them. Yeah.
It is true that these are kind of synthetic because you don't have an entity. That's right. You're not buying a share of a company or something like that, or you don't have an ongoing entity like Case Western. But the originators, the people who are making the mortgages, do have reputations. And in fact, if you look in some securitization deals, you'll see representations that, none of these are mortgages were originated by We Make You Money, Inc. So there are certain originators who the issuers refuse to purchase mortgages from. So there is some institutional investigation, but overall, generally the due diligence is going to be focused on the actual loans.
Anybody? Yeah, Professor, would you possibly be able to go to the microphone so we can record what you say?
Can
Thank
you start
you.
with an easy one?
No, I'm certainly not an expert in this area. So I think I've been misrepresented somewhat. But I would like to say that if you look at credit rating agencies, generally, have they done a good job? And so if you look outside the mortgage market, I'd argue that for the most part they have done a good job. And it's not their business to rate, they try and rate through business cycles. So their ratings generally, when the business cycle is down, they don't just drop all the ratings and immediately raise them up when business cycles are good and good times. They try and look through the business cycle. So they don't never claim to be predictors of future credit risk. They just rate through business cycles. And so I think when you look at the mortgage market, you have to be a little bit careful. Like, there's enough blame to go around everywhere. But what was their function in the mortgage market? And I'd say the biggest weaknesses was when they rated complex products. That's when they really messed up. But then you look at the buyers of those complex products, and they're generally not innocent individuals. They're people with lots of good information. And in fact, if you look at the Goldman Sachses of the world, they were doing credit rating arbitrage strategies. They'd understand how the ratings were determined, and they would manipulate that and set up trading strategies that would exploit that. So, it's a matter of compensation. If you look at compensation of investment bankers and compare it to compensation of people developing the models at the rating agencies, there's a complete gap there. And so, blame can be passed around on all occasions. But I think the biggest thing is that credit rating agencies deserve some credit or some break, because outside the mortgage market, they've done a pretty reasonable job.
Yeah, just one thing to add to that. If you look at the historical RMBS ratings by the credit agencies and I'm not talking about the CDOs squared and cubed and all those sort of funky things, but just the RMBS's ratings that were starting in the 90s, the credit rating agencies were dramatically more likely to issue upgrades than downgrades in that. Where everything changed, I think two things happened at once. One was where they started to do increased underwriting to the teaser rate instead of the fully indexed rate, and so that made it harder for the credit rating agencies to know what the real risk was. And then secondly, when we started to get into these really complicated products, and I think they just should have left well enough alone and say, these aren't going to be, they're not investment grade now, we need to give it 4 or 5 years and see how this plays out in the market, and then then we can develop our historical models. So I think that I agree with Peter, and I agree that also that there is no one entity that is to blame here. There is blame at every level, and some of the blame has to do with greed, and some has to do with irrational exuberance, and in the worst cases it has to do with exploitation.
But I'd like to hear Mark's comment on this, but isn't the point that because of their incentives, they weren't willing to say we can't rate this because they make money from rating, and because their customers expected them to rate? I mean, I think the logical answer is yes, they couldn't rate it, and they shouldn't have rated it. But to not rate is to rate, and therefore there's an incentive for them to at least issue some sort of rating. I mean, Mark, what do you think?
Yeah, well,
you got to grab that microphone.
Sorry. I think the rating agencies did a commendable job over much of the 20th century in their rating. And one of the reasons are you sort of think of an economy that is sort of more predictable in some ways than the economy we have now, especially in terms of the financial instruments. I mean, if you're rating GM and they're issuing debt year after year, yeah, you have a pretty good idea what GM is like and what they're doing. And whatever debt they're issuing is changing modestly up and down. Well, again, if you remember my chart on CDOs, I mean, CDOs were growing 500% a year. I mean, how can you actually rate something that's new, that is that new, and that is growing that quickly? I mean, maybe there ought to be trading triggers. I guess I don't understand Wall Street that much, but if the market drops a certain level in a day, that you sort of stop trading for a while and let people cool off a little bit. Well, maybe there ought to be rating triggers at any market segment that grows over more than 100% a year. Well, we're not going to rate anything for a while until we have a better idea of where this market's going. I mean, I think that I don't want to give generic blame to the rating agencies as much as the specific mistakes regarding the mortgage market, where I think that they, I think it really, maybe I'm not as strong on ignorance. Maybe I let them off the hook too easy on that. But really, the incentives, the ignorance, and the stress, I think really they, regarding that, they should have known better. I really,
Professor Posner.
Thanks. I wanted to point out a trend in the way that the SEC is making adjustments to the way it regulates the securities industry, and how that trend might affect the possible future solutions for rating agencies. Now, that trend is that the SEC has come under tremendous pressure since about 2002 from the EU, which has meant that it's had to compromise on a lot of its longstanding positions. Perhaps the most obvious to this mess that we've been talking about is the Financial Conglomerates Directive in Europe. And so there were adjustments made in the way that investment banks were regulated in this country. Now, the point here, the reasons for this are a bit complicated, but it's basically that the firms on both sides of the Atlantic want coordination. And the EU has this huge, massive regulatory project going on. And so it's put this new pressure on the SEC. So my point here is that in discussing possible solutions for rating agencies, you have to also pay attention to what's going on in Europe, because that's going to bear on what happens in Washington after the elections. And in Europe, there's a full-on assault against what we call, in my field, international political economy, private authority, what you've been alluding to. The two most conspicuous examples of private authority are the rating agencies and IASB, the accounting standard setter in London for international accounting standards, which the United States is on the way to adopting. So, this assault is really getting very interesting. There's new legislation underway in Europe regarding rating agencies. Maybe you know something more about this than I do, but I just was on the web today and noticed that the market authority who's in charge of introducing this legislation in the European Commission, has basically come out and said that self-regulation and private authority don't work. And this is not new in Europe. There's been lots of there's been lots of voices in this direction over the years, but they haven't been able to get what they want. But of course, their great victory, if you've been following these things, is it looks to me like in a joint effort with the SEC, and I think this is driven by the European Parliament, they're going to monitor what had been a private authority over international accounting standards in London. There's, if you check out on the website, it looks like it's a done deal. So my point is that we may talk a lot about possible solutions and the proper balance between private authority and government in this country, but this is not the old world where the SEC was able to do whatever it wanted to. It's under tremendous pressures. Of course, the underlying assumption here is that international finance looks in 10 years the way it does today, and so that's everything is questionable at this point.
But I have to ask, Ted, run.
One comment for Elliot. I'm not sure that in Europe there is this phenomena of mortgage-backed securities or collateralized debt obligations in the terms of residential mortgages. So I think that's something that still could be peculiarly American. But my question was really perhaps to Kathleen Engel, and that is, it was my understanding that the only function that the rating agencies did was that they decided which of these tranches would be paid off first. That's why I was astounded by your comment that the waterfall provisions were not even completed if the rating agencies didn't do it. But if that is the case, then of course a mortgage would be in several of these tranches. It would be in several issues, would it not? Because the one tranche would be the first payments that came from this bundle of mortgages would be paid off, and that would be rated AA or AAA or whatever it is. And the ones that were last would be obviously rated hardly investment grade. I don't know what happened to those that were paid off last, whether they were ever sold and so on. But I'm astounded that the documentation was not checked. And is that not your understanding? And the only thing the rating agencies did was to determine which, in the scheme of things, is this tranche going to be paid off, from the first payments of this bundle of mortgages or from the second or the third tier or whatever. The other question is, you mentioned that most of these mortgage-backed securities and collateralized debt obligations were privately placed. And the buyers were, I assume, they were the hedge funds, by and large. Somebody mentioned some pension plans, but I would think a pension plan could not buy one of these things or instruments. I don't know. Well, I'll leave it at that for the moment.
Okay, so that was like 10 questions in one, but I'll see if I can come down to 3 answers. 2, okay. The first thing about who was buying this. The investment-grade tranches were being bought by pension funds. They were being bought by municipal governments. There's this tragic story in Australia where a little shire in Australia was convinced by a Lehman broker-dealer to purchase these securities, and then they couldn't pay their police and fire department, and they're having to lay off teachers and all of this because it went belly up. So the investment-grade tranches were bought by anybody. And in fact, I think they're not. No, I think that pension. I actually don't know. I mean, I think under ERISA you can. There's nothing that. Well, actually, if they're public entities, they're not going to fall under ERISA. But I think that they're allowed to do that, to privately purchase. And I think that one of the problems, actually, is that you had pension funds that had huge demands with the retirements on their funds, and they were looking for ways to make money quickly, right, and a lot. And these had very, very high returns initially. before the crash. So and there was excess money. We were a period of tremendous liquidity. There was so much cash flowing around, both in the United States and around the world. And so you had lots of money looking for an investment that had a high yield and that would not be the stock market, right? So looking for diversification. So that's part of the answer. In terms of what the credit rating agencies' roles were in structuring the deals, I think the deals were pretty much structured by the investment banks. But what the credit rating agency's job was, in terms of like what are the tranches going to be and things like that, but what the job of the credit rating agencies was to figure out what additional provisions, what credit enhancements needed to be added to the deal to bring it up to the top tranche to an investment grade quality. So they would be doing these risk assessments and saying, okay, if you put into place this over-collateralization provision, I can bring this third tranche up to an A rating or something like that, and that was their primary goal.
Final word for Professor Rome.
One of the odd things about the ratings and the pension funds and others buying these highly rated securities on the based on mortgages is that sort of in concept, securities that are rated that have the same rating should have the same rates of return and the same risks of default. They didn't. Mortgage-backed securities and CDOs that were rated equivalent to other securities had higher rates of return. That should have been indicative right away that they were more risky. And they've had vastly higher rates of default than traditionally traditionally rated investment grade. So, ideally, if the rating agencies do their job, the ratings reflect true rates of risk and true rates of default, but they don't. Whether they can, we'll see you again in 2018.
Thank you very much for coming. Thank you especially to Professor Engel and Professor Rome for their talks, and to the rest of you for your discussion.
Thanks very much.